This is Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 4 videos on trading breakouts. Breakouts can be scary and they can happen very quickly and go far very fast, and some traders are afraid to enter. One trick that you can use is to look at a smaller time frame for an entry. Breakouts eventually weaken, and when they do, the market is probably in the early stages of transitioning into a trading range. Once you see that, you need to begin to change how you're trading. This is a dollar versus the yen weekly chart, and a very, very strong breakout. Lots of bull bars, lots of consecutive bull bars closing on their highs. A micro channel, about a 15-bar micro channel, every low at or above the low of the prior bar. The bulls are buying very aggressively. Some traders are afraid to buy. They look at this and they say, I know my stop has to be, it has to be here or here, and I don't want to risk that many points. An alternative that the Forex market offers is that you can trade very, very small. Another is, especially if you're a stock trader in addition to a Forex trader, is to use a stock replacement strategy. In this case, you could think of it as a Forex replacement strategy. At this point, if you were thinking about entering, your stop is about 15% below where you are, 1,200 pips. And for a lot of traders, that's too much, even if they're trading a small position size. An alternative is to look at an ETF that is comparable to the Forex market. And if you're trading the dollar again, one is the EWJ. It's an ETF, it trades like a stock, and you can trade options on it. So you can trade calls or call spreads, and thereby defining your risk, containing your risk. Another strategy that traders can use is to enter early on a smaller time frame. Here is a 5-minute chart of the euro versus the dollar. Very strong breakout. Market rallying 40 pips. Once you start to see a series of bull bars, 3, 4 consecutive bull bars, 3 with good-sized bodies closing on their highs, very little overlap, not big tails on tops of the bars, you know the market is going higher. There's at least a 60% chance that it's going to go up for some kind of a measured move, maybe based upon the open of the first bar to the close of the final bar, which would be somewhere up here. You have to get long. Some traders are afraid to buy at the top because they're afraid that the market could reverse and go the opposite direction. The probability of that is small when the breakout is that strong. However, traders who are inclined to buy pullbacks and not buy closes can look at a smaller time frame chart and enter on a pullback there. For example, this green box is the 1-minute chart of this green box. And although there were no pullbacks here, on the 1-minute chart, there are pullbacks. If you do not want to be buying closes on the 5-minute chart, an alternative is to buy breakouts of bull flags on the 1-minute chart. You know the market's going higher when you see this. The chance of it reversing down without at least a micro double top is 30%, 20% or so. And therefore, any reversal attempt will probably fail. You look for reversal attempts on a smaller time frame chart like the 1-minute chart and expect them to fail. And once they start to fail, once the bull trend starts to resume, you have to assume the market's going to go higher. You could buy this close on the 5-minute chart. But if you prefer pullbacks, you can look at the 1-minute chart, and this blue box is this blue box. On the 5-minute chart, the first time a bar traded below the low of the prior bar was way up here, which is way up here. If you were going to be buying a pullback, let's say you placed a limit order to buy at the low of this bar, you'd get filled right here. And if you looked at the 1-minute chart, your entry price would be right here. On the other hand, after you've had 3 strong bull bars or 4 or 5 reasonably strong bull bars, and you prefer to buy pullbacks than buying closes, you can look at the 1-minute chart and look to buy a pullback on the 1-minute chart. Aggressive traders, as soon as they start to see this turn up, they'll put up a 1-minute chart and just look to see if it's starting to get 3, 4, 5 bull bars closing on its high, and then they'll just buy the market. Traders who prefer pullbacks can buy at the low of the prior bar. Had a trader bought at the low of the prior bar on the 1-minute chart, that is 28 pips below the trader who waited to buy the pullback on the 5-minute chart. And it's 7 pips below the entry of traders who bought the close on the 5-minute chart up here. Stop is closer. If you buy here, or if you buy here, your stop is right here. Also, there's more reward left in the trade. Here's a weekly chart of the euro versus the dollar. Very tight bear channel. The odds are the market's going to fall at least a little bit more, possibly a lot more. We have a breakout here. You could sell the close. We have another sell the close market here. You could sell that close. If you sell here, stop at a minimum above the most recent strong bear breakout here. I would do this and not this. Alternatively, the pullback or the top of the bear trend. Those are reasonable stop locations, but look at the price, how much you're risking. If you put a stop up here, it's 1,400 pips up. And for most traders, that's too much risk, even if they trade a very small position. If you're looking to sell and you don't want to risk that much and you don't want to wait for a pullback, an alternative is a stock replacement equivalent. For example, the FXE is an ETF that tracks the euro versus the dollar. If you're thinking at this point that you want to get short and you don't want to put a stop up here, you could simply buy a put or buy a put spread. Extreme sell climax. The market is strong here, it's strongly bearish here, it's even more strongly bearish here, and then again very strong here. When you see exceptional strength coming 20 or more bars into a trend, this is maybe 30 bars into a trend, it's more likely near the end of the trend. Sometimes you'll get a second leg down, other times this is going to be the end of the move. It might go sideways and form a micro double bottom, and then probably work up to the top of the most recent sell climax. Here, it became a small bear flag, and we had another dramatic sell climax. And the first target of a reversal is a test of the top of the most recent sell climax. Instead of bottoming here, we have a small wedge, down, and then up on that bull bar, and then down, up. We have a strong bear breakout, and in fact, it fell for a measured move down. Typically, when you get a strong breakout late in a trend like this, it's more likely an exhaustive end of the trend, less likely a measuring gap. Here is an example of a measuring gap. 25% chance it's going to fall for a measured move, and it did. Here's the top of the move. Here's the bottom attempt. And then instead of bottoming, we broke out, and we did fall for a measured move. So what's going on here? We have consecutive sell climaxes. As I said, sometimes when you have an extreme sell climax late in a trend, the market reverses from there. Other times it has a second strong sell climax. Very rare to get a third very strong sell climax from here. At this point, at the end of that second strong sell climax, traders are looking to buy a reversal up to the top of the most recent sell climax. Also, the probability is higher because it's almost exactly at a measured move down. And now we have a micro double bottom, increasing the chances that we're beginning to move up here. Traders will buy on the reversal up. There's a good bull bar here, 3 bull bars here, and now we have a very good looking bull bar closing on its high. If you're short here, you're going to take profits here because you know the market's at a minimum going here. And if you're not short, it's a reasonable place to get long. If you're trading the FXE, let's say you bought puts or put spreads, you probably would take partial profits at the end of this sell climax when it started to pause, and you would get out of your final position either above this bull bar or here, micro double bottom, measured move down, consecutive extreme sell climaxes late in a bear trend. The odds are high the market's going to begin to transition into a trading range. 5-minute chart of the euro versus the dollar. A strong breakout. This is a trading range, a triangle, and we have a strong breakout. Usually by the end of 2 consecutive bear bars breaking below the low of a trading range, you know the market's going lower. Traders will sell that close, and you can look at the open of this bar compared to the close of that bar. It's slightly below. That means as soon as this bar closed, a lot of traders just hit the button to sell the market, and that's what caused that. And when you see a strong breakout like this, the odds are you're going to fall for about a measured move. The strong breakout began here, the close of the breakout bar is there, and this is not quite to a measured move down. In any case, by the close of this bar or the close of this bar, the odds are high you're going at least a little bit lower. You have to get short. One way to do it is to sell a breakout of a bear flag. Here we have an II. This bar is inside this bar. This bar is inside that bar. It's a bear bar closing on its low. The bulls who are hoping for a reversal and buying here will get out here. And the bears have an opportunity to get short, looking for at least a little bit more down. A low 1 bear flag. It doesn't matter if you sold at the market, at the close, or here. Your stop is up here. This could easily go up for a couple legs, maybe form a small wedge bear flag, and then go down. And therefore, if you're taking this short, it's probably better to put your stop up here if you're holding for a swing down rather than above that bull bar. A lot of traders don't want to wait for a pullback because they're afraid they'll miss too much of a strong trend. And other traders don't want to be selling closes because they're just scared. It's falling so fast, they're afraid of it reversing up very quickly, and they don't want their stop that far above. Alternative, look at a 1-minute chart. Here is the 1-minute chart of the euro versus the dollar, and this pink box is this pink box. Had you sold the breakout below this II low 1 bear flag, you would have been filled here. On the 1-minute chart, that would be your entry price. This is a reversal attempt, a second reversal attempt, a third reversal attempt. The trend is very strong. The reversal attempts are minor. The best the bulls probably get is a trading range, and the reversal is probably going to fail, especially when you see how strongly down the market is falling on the 5-minute chart. And therefore, traders will sell on the resumption down. This is the entry on the 5-minute chart, right there. If the market's falling quickly like this and you know it's a sell the close type market, you know the market's going lower, and you're just waiting for a pullback, waiting on the 5-minute chart, you might have to wait a long time before you get a pullback. Alternatively, instead of selling closes, you could put up a 1-minute chart and look to sell the pullback there. For example, place a limit order to sell at the high of the prior bar, and you would have been filled here. Remember, the stop entry traders on the 5-minute chart got filled here. Once you start to see 3 or 4 or 5 bear bars with no overlap and no pullbacks, and you're thinking the market sell the close, or if you're seeing this, 3, 4, 5 bars here, you got 5 bars without a bull body, and now we got 2 bars closing on their lows, you know it's going lower. Instead of waiting for a pullback, you can flip to the 1-minute chart and place a limit order to sell at the high of the prior bar. Had you taken that short, selling at the limit order of this bar, you would have been filled right here as this bar went above that 1-minute bar. And that would have been 10 pips above the stop entry on the 5-minute chart, which is right here, right below this bar, right here. Alternatively, when you see the market starting to sell off 3 bars, 4 bars, 5 bars, instead of selling closes, you can go to a 1-minute chart and look for the same thing. If you start to see 3 or 4 or 5 consecutive strong bear bars, you can simply sell at the market or sell on the close of a bar. And had you sold right here after these 5 bear bars on the 1-minute chart, you would have been filled 16 pips above the stop entry on the 5-minute chart. It allowed for an earlier entry. Here's a low 1 bear flag on the 1-minute chart as well. We have a pullback, and you could sell below the low of the prior bar, betting that the bear trend is resuming. Whenever you see a breakout that does not quite look all that strong. You have to be wondering if the breakout is converting into a trading range. We have a triangle, reversal up, reversal up, reversal up, higher lows, lower highs. We have a pretty good bear breakout, but then a fairly strong reversal. 3 consecutive bull bars, not all that big, fairly prominent tails. It's not all that strong. And only one of the bull bars closed above the top of the trading range. There's no confirmation. Usually traders like to see consecutive breakout bars before they conclude that a breakout is going to be successful. Instead of one more bull bar and 2 closes above the trading range, we have a big bear bar. When you see that, it's unlikely that the market's going to enter a bear trend right away. However, instead of a strong bull trend, this might be a bear leg and a trading range. We might get a very deep pullback. So instead of a reversal up into a bull trend, it might be the end of the bull trend and the conversion into a trading range. Also, look where we are. We're at a price level where the market reversed repeatedly. The market thinks that this is a reasonable price. It went below it, it's too low. The market had to get back up. It went above it, maybe too high. We might be continuing this trading range. This range is about half of the height of a typical day, less than half of a height. It's only about 10 pips tall. The odds are the range today is going to get bigger. Reversal, failed breakout below a triangle, strong reversal up. The market's always in long, but the bars are not all that big. You have tails on the top of the bull breakout bars, and you have bad follow through. More likely, this is going to be a bull leg and what will become a trading range than the start of a strong bull trend. And since the trading range is likely, you have to expect the market to reverse a lot of the bull leg. You have to expect a deep pullback. And that's what we got. We got a deep pullback beyond a 50% point, below the bottom of the bull breakout, testing the bottom of the trading range, testing the top of the buy signal bar on the reversal up. New high, they sold the new high. New low, they're probably buying the new low. So this breakout, the absence of follow through, the bar's not all that big, the tail's on top, made it more likely that today was going to be a trading range day than the start of a strong bull trend. Traders are buying low, they're buying below bars, they're buying reversals up from a sell-off, and they're selling above bars, above this bar, and they're selling reversals down. You can see the videos on trading and trading ranges for stop placement and how to trade when the market is likely in a trading range. Trading range, you buy low, you sell high, and you scalp. Buying low can be buying for a swing up, or it could be buying back shorts. Traders who sold that high or sold the reversal down will buy back their shorts. And selling high, selling above here or in the reversal down, high in the developing range, is both from bulls selling out of their longs to take profits and for bears selling into shorts. Both bulls and bears, when they see this type of price action, believe the market's not going to go very far, and therefore they're taking quick profits. The range is very tight. Minimum scalp in the Forex markets is 10 pips, and it would be pretty difficult to make 10 pips here more than once or twice. Is this a buy the close bull trend? We have 3 consecutive bull bars. We have a weak rally, and now we're getting a stronger rally. Yes, it's reasonable to buy that close, even though you know we might get a big pullback. At this point, you know the market's clearly always in long, and that means either it's going to be in a trading range or in a bull trend. And therefore, you can buy that close and put a stop down here and look to buy more above a bull bar or on a reversal up, betting that the best the bears get is a bear leg and a trading range. The chance of a bear trend is small. the odds are if you buy that close and the market sells off for 10 or 20 bars, it's going to get back to that close. Whenever the market is giving you a reasonable trade, for example, it's reasonable to buy this breakout. It usually allows you to get out and avoid a loss. Usually it allows you to make a profit. This resumption of the bull trend did not allow these traders to get out without a loss. However, this reversal up here did. Bulls knew that if they buy here and put a stop down here, the odds are 70% or more, maybe 80%, they could at least avoid a loss by buying more lower and then getting out at the midpoint of their two entries. For example, if you bought this close and you bought more above this bar, your average entry price is right around here. You could exit here, and the loss from this entry would be about the same as the buy from this entry, and you'd avoid a loss. Or you could try to get out here. You'd get out break even on your first entry, and then with a profit on your lower entry, and the trade would result in a profit. For the bears, they see a breakout above the top of the range. First reversal down in a tight bull channel, probably not going all that far. However, a second reversal down in a bear body, even with that tail, will probably get at least a couple legs down. Bears will take that short, looking for at least a scalp. That means at least 10 pips. They did not get 10 pips. The market has to fall 12 pips below this low. In other words, 11 pips below their entry price for them to exit with 10 pips. It did not get there. Instead, it reversed up from a higher low and a small wedge. And a lot of the bears would give up and buy back their shorts here with maybe whatever that is, 6 or 7 pips profit. The buy the close bulls here, after they see the 3 legs down and the weak sell-off, the lack of consecutive big bear bars, know that this is probably a bear leg in a trading range, and they expect the market to get back to the top of the range, which is up here. And therefore, they'll buy more on the reversal up. It's also about a 50% pullback, a little bit more, and it's a small wedge. The bulls who bought here and did not exit, they held with their stop down here, were disappointed by this follow-through and by the number of bars and the depth of this pullback. They now believe the market's in a trading range. And therefore, they're switching from swing mode, hoping to hold for a big swing up, to scalp mode. They're looking to buy low, in other words, buy more here, and then scalping once it reverses back up toward the top of the range and their original entry price. They can get out break even on their first buy, buying that close, and then with a profit on their second buy. The bears will sell up here, knowing that the bulls will take profits at that high close. They'll also sell at a prior high and scale in higher. And they'll also take a second entry short at the top of the range. The bears will sell a strong bull bar, betting that the breakout will fail and have bad follow-through and reverse down. Also, they'll see this as a wedge with the first push up here or here, and then second and third. So a wedge rally in a probable trading range. You could also call it a wedge here, 1, 2, 3. Bears will sell the reversal down, betting that the breakout is failing, especially since it's a wedge and a trading range. Again, the absence of strong consecutive bull bars. Good bull bar, bad follow through a doji. Good bull bar, bad follow through a bear bar. Good bull bar, bad follow through a bear bar. This is probably a bull leg in a trading range, and you can see we're at the top of the trading range. The market's still always in long all through here, and therefore any short is a scalp. This is not a major reversal. We don't have a trend. We have a trading range. At this point, the market is clearly always in long. While you possibly can sell, it's usually better to concentrate on longs. The market was short through here. It became always in long here. Certainly always in long here. Usually easier to make money looking to buy, even if you're only scalping. Early in a trading range and the market just becomes always in long, usually the first trades you should be taking are buys. just in case this becomes a higher low in what would become a strong bull trend. However, once you start to see the bad follow through, the lack of a strong buy signal bar, bad follow through, bad follow through, bad follow through here after this, you're going to conclude that a trading range is more likely than a strong bull trend. And you're scalping because you're not expecting a big profit. Can you buy here and then sell that close and reverse to short? Well, most traders, most experienced profitable traders do not like to reverse. It's hard to become objective about a trading in the opposite direction without first getting out of your current trade. So a lot of traders, if they buy here, maybe they'll get out here. If they get out here, they'll probably not take this short. They'll probably wait a bar or two and then think about how to get short. Maybe sell above this bar. Here we have 4 or 5 bars down and we're still at the top of the range. It's simply difficult to do two things at once. Think about getting out of a long and thinking about getting into a short. However, as with all trading, if you're comfortable doing something and it's profitable, then you can do it. The bulls have a very strong reversal up from a failed breakout below a triangle, but disappointing follow through. The market is still always in long. The bears failed to get consecutive big bear bars. They have consecutive bear bars, but not all that big. And they do not have 2 consecutive big bear bars closing on their lows. This is therefore more likely a bear leg and what will become a trading range than the start of a big bear trend. Also, we're around a 50% pullback, and we're still obviously above the bottom of the strong bull reversal. The market is still always in long. It's still more likely to go back up to the top of the range than it is to be beginning a bear trend. The bulls can buy for any reason as the market's falling, confident that this is a bear leg in what will become a trading range, but they have to rely on their stop, either below the bottom of this bull breakout, which I would not do, or below the bottom of the entire bull reversal, the bottom of the bull trend. This is a more reasonable stop. I would not choose that stop, but a lot of times when you get a reversal up and then a small pullback like this, and then a breakout to the upside, the market will come down and test that low and form a double bottom with that low. This is basically a double bottom with that low, slightly higher high. The difference in the price of these two lows is small. I would therefore choose this one. When the market is going up here, the market became always in long. We stayed in a trading range for the entire session. However, it stayed always in long. The bears did not do anything here or here or here to make traders think it was no longer always in long and instead became always in short. It probably became always in short on this strong reversal down, maybe by the close of this bar or this bar, but it's also the end of the Asian session. And had you traded through the Asian session, you're probably looking to exit because it's the end of your workday. This is a second entry short for a failed breakout above the top of the range. At this point, the top of the range is here. We broke above, we reversed down. We broke above again a second time and reversing down a second time. That's a reasonable short, plus you have a bear body. You can place a limit order to get out with a 10 pips profit. The market got near your profit, did not fill you, and now you're getting a double bottom and a bull bar for the reversal up, possible higher low. We have a higher low here. This might be another higher low, and it's reasonable to get out here. You did not get out with your full 10 pips, but you get out with a reasonable profit, and getting out there is a reasonable thing to do, because this could be the start of another leg up. Now we have a bull trend, a deep pullback here, another deep pullback here. Is this a lower high major trend reversal? I wouldn't call it that, but I would call it a reversal in a trading range. If you want, you can call it a head and shoulders top, left shoulder, head, right shoulder. We don't know what took place here. If this was a big bear trend, then this is a head and shoulders top bear flag. On the other hand, if it was a big bull trend, then you can call it a head and shoulders top inside the bull trend. Doesn't matter. It's a head and shoulders top pattern. It's a lower high. It's a possible swing down. We have a lower high and a possible head and shoulders top. 40% chance it's the start of a swing down. End of the session. If you're going to be trading for the next few hours, you can take the short. I began by talking about how if you're seeing a strong trend beginning and you're waiting for a pullback, the pullback might not come for a lot of bars. An alternative is to look at a smaller time frame chart and then enter on a breakout or on a pullback on that smaller time frame chart. For example, if you're trading a 5-minute chart, you can look at a 1-minute chart. If you're trading a 60-minute chart, you can look at a 5-minute or a 15-minute chart. Next, I talked about breakouts that don't look quite good enough. And if you have a weak breakout, very often the market, instead of continuing, is going to evolve into a trading range. If you see that begin to happen, you convert from trend type of trading into trading range trading, looking to buy low, sell high, and scalp. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading breakouts.